Okay, let's get started. So good afternoon, everyone. Thank you for joining this week's live Q&A session. My name's Dan. I'm a Senior Customer Success Specialist here at Snap. I'm also joined by my colleague, Yulia, who is also a Senior Customer Success Specialist, and she's going to be helping me field any questions that may come through during the presentation. In regards to asking questions, uh, you should have a Q&A section within your Zoom, so feel free to type over any questions you may have. Hopefully we can answer them all within the half an hour that we have together. If we do not get back to anybody, be assured that we will follow up with you after the call today. So in regards to today's agenda, we're going to be comparing a few different scenarios for our couple that we are looking at, specifically looking at when to take CPP, whether that be at age 65 or at different ages. We will then compare those scenarios and see which is the optimal one to select for our clients. And then we will also take a look at the cash flow management, specifically the order of withdrawals from the financial assets. And then finally, we will be running a sustainable spending recommendation. So before I hop over into Snap itself, I just wanted to highlight our Help Center, which can be found at the top right hand of your screen once you're logged into Snap. So if you come over here, this is a great resource for all things Snap. It's broken down into various categories depending on what you're looking for. We also have an awesome search feature. So if you enter the keywords in there, you can usually find an article or a step-by-step guide on how to model something specific in Snap. However, if you're not able to find the article you're looking for, that's when our team is available to you Monday to Friday, 9 a.m. to 6 p.m. Eastern Standard Time. So please feel free to give us a call. We're more than happy to help out. You can also reach us by just hitting contact, providing your information, your question. It goes to our general email inbox, and we try to get back to everyone within 2 hours. Now, in regards to signing up for future webinars, you can come over here. There is the live support session product walkthrough and Q&A register here. And then there is future or upcoming dates. One is in a couple weeks, and you can register for that here as well. So I'm going to hop back into Snap. So I'm in my main page, my client page. I currently have all my clients hidden. You have the option to do so by selecting the 3 little lines up here to show all your clients or hide all of your clients. For now, I'm just going to search by my client's last name. And there we are. So we're going to be working with Aaron and Ryan Barber. And I'm going to hop into the base scenario, which is taking CPP at age 65. I've prepared these scenarios ahead of time just for time's sake. So again, just by clicking on the little gear icon, that'll bring me directly into scenario setup for this particular projection. And quickly, we'll just go through the general assumptions I've made in the plan. In regards to the clients, fairly straightforward, first and last names, dates of birth, and province of residence. On the Generals tab here, we have the plan starting in 2025. We have Ryan retiring at age 60. In the same year, Aaron would be 58. And then at the end of the projection, we have it running until age 100. And for Aaron, 98, again, ending the projection in the same year. Now, in regards to the inflation rates, so these are rates recommended by FP Canada, and it's Snap's defaults. You are more than welcome to update these, whether it be the general inflation rate or the indexing rate for CPP and OAS, and the very same for rates of return. So these are what's recommended by FP Canada. However, they do not account for any fees that you may charge your clients. So we do recommend that you adjust these accordingly. Now, if you were to make any changes to the inflation and or the rates of return, and say you want to use that for future plans moving forward for new clients that you introduce into Snap, you do have the option to select defaults down here and save current page settings for new scenarios. So any new plan that you begin for a new client will have your defaults already saved for you. You don't have to come in and re-enter those. Another thing to highlight is throughout Snap, you're going to notice these little question marks. So those are little prompts to provide you a little bit more detail with what those fields are looking for you to enter, just providing a little bit more clarity. And again, those are throughout the tool itself. So I'm going to hop over into expenses. So the base expenses is what the clients intend to spend during retirement. And this couple has specified that they want to target 70,000 after tax as their spending goal during retirement. They don't have any additional expenses, but if your clients were to have any, like a vacation expense, that's where you could add them under the additional expenses. So I'm going to hop over into income now, just paying attention to whose tab you're on. Right now we're under Ryan, indicated by the dark blue here, also indicated within the title itself. So we have his employment income, 100,000. We've selected it as employment as type of income. It is taxable. It is RRSP eligible. And by default, SNAP will cease the income the year before retirement, which for Ryan was at age 60. And the very same thing for Erin. I've included her income as well. And then stopping at age 57, the year before she intends to retire at age 58. Now, sticking with Erin's tab here, I've included an RSP, a TFSA, and a joint non-registered account with the according values. I've linked the right type of account, just paying attention to that with your description. And then I've assigned it a portfolio mix. And then based on that mix, a total rate of return based on that weighted average for those accounts. I've also included a home, their principal residence under real assets. The value of the account, the cost base really doesn't apply to the principal residence. However, if you did have a rental property, this is where it would be important to update the cost base of that rental property. We're assuming that it would be appreciating with inflation at 2.1%. Future purchase age. So because they currently own this home, I'm leaving that blank, just like future sale age. They don't intend to sell the home, so I am leaving that blank. But these are the sections where if they were to purchase, for example, in the future or sell in the future to, for example, downsize their property, that's where you could specify the age or a specific date and time by clicking on the gear icon here. And then I've indicated that this is a joint asset. Again, capital gains tax won't apply to the principal residence, but if it were a rental property, you would select yes. And then the capital gains tax would be factored into their tax when that property was disposed of. And the very same thing for Ryan. So I've been updated his assets, the RSP, TFSA. Here's the joint non-reg that I've included. And again, the joint principal resident home. Now, they do not have any debts, so there's no mortgage to enter. In regards to government benefits, we do have them starting the CPP at 65. Same with OAS, assuming 100%, and then for CPP, assuming the national average, which is SNAP's default. If you were to have a Service Canada pension statement, for example, this is where you could come in and actually update the value right here. Another thing to note is I've also prorated the first year of CPP and OAS. So that starts the benefit the month after their date of birth. So we just don't want to overstate the first year of benefits. So in this example, the first year will be a prorated amount of the 10,517 and 8732. Now, they don't have any insurance products or they have no children, so there's no RESP involved. So what I'm going to do now is hop over into the planning pages. Let's take a look. So right now we're on the individual view. Let's take a look at the combined view. So you're going to notice in the first year prior to retirement, the expenses are grayed out. So just a little explanation on what's occurring prior to the cash flow management start age, which is at retirement for this couple. It can be moved, but by default, SNAP will start it at the retirement age. So what's happening prior to retirement? In this example, it's taking their employment income. So this is a combination. You could expand this out and you could hover over these titles to see exactly whose income that is. I'll collapse that back. So it is taking into account the employment income, less taxes. They do not have any savings. And as I mentioned, there is no debt payment. So what's left over is 136,533. And SNAP is assumed that's spent money on lifestyle. Now, what's occurring starting at retirement, when the cash flow management is turned on, I like to refer to as SNAP is doing the heavy lifting for you. And what I mean by that, it's automatically going to start taking funds from the financial assets in order to cover the base expenses and any taxes that would apply in that given year. Now, as I mentioned, there's no contributions, and Aaron and Ryan excuse me, have specified that they do not want to contribute prior to retirement. But in the event that they did, contributions can be entered on the individual's planning pages. So I'll just do this for illustration purposes. So for the RSP, for example, if you were to hover over this zero, it's actually going to provide you with the contribution room for that year for the client. So in this case, 18% of his income, 18,000. So I'm going to enter 18,000 here. And the very same thing for TFSA. If you hover over, you can actually see the contribution room. And I'm going to assume he's going to max out his limit for that year. Now you can see that these cells are now highlighted in yellow, indicating this is an override that I've input. The other thing to note is the run scenario has turned from green to yellow, indicating that the plan just needs to be rerun. So I'm going to do that now. And now you can see this has gone back to green and the contributions have been applied to those two accounts. But again, because they've said that they don't intend to contribute, I'm going to clear those overrides. There's a couple ways you can go about doing that. You can click right on the figure. You could say clear override. If there was multiple overrides year over year, you could copy the clear override down to a certain age. In this case, it's just 1 year. So the other way of going about removing that override is just clicking on the X. You can see that yellow cell disappears and clicking on this one. And again, just indicating let's rerun that plan. Okay, so I'm going to go back to the combined view. So based on the spending goal of 70,000 during retirement, let's scroll to the bottom of the projection to see if that's plausible. And I don't see any shortfall, so things look good. I'm going to move over from left to right. So we can see at the end of the projection, the value of the TFSAs, again, this is a combination view, is around 31, 32,000 and 163,000 in regards to RIF. So if I go over to the estate before tax column, and look under the combined view, we get a bit of a breakdown of what the estate after tax would look like. So again, a combination of those TFSAs and RIF accounts, the real asset being their home for a total asset of 2.1 million roughly. They have no debts. There's no insurance incorporated, so no insurance proceeds. So again, the 2.1 is the estate before tax. Tax on estate would be 42,000 roughly, which would be relating to the RIF accounts being taxed on final disposition, and then the estate after tax value. And that is available in any given year if you want to see what that looks like. Okay, so now that we've kind of gone over our base scenario, I do want to just take a look at what things would look like if they took the benefits at age 60 versus age 70. And again, I have gone ahead and made these in advance. How I did so was just copying my base scenario. So you can do that by going to the three little lines up here and copy the scenario. it'll bring you over into that new copy. So I'm going to head over into my CPP at age 60 scenario. And I'm just going to go down to my government benefits. And here is where I've indicated that they're starting to take those benefits at age 60. So going back to the planning pages, again, going on the combined view, we can now see those benefits coming in earlier for the CPP. And then if we scroll down, we actually see they run into a shortfall indicated by the red rows here. So not ideal, not an ideal situation for taking CPP earlier in this particular case. I'm also going to hop over now into my CPP at age 70. And I haven't mentioned, but there is a couple different ways you can switch between scenarios. You can click on the client's name, and that will bring up the different scenarios. You can also go to those 3 lines, and you can switch scenarios using this method. So again, I'm going to go back and directly into scenario setup, clicking this gear icon. And I'm going to go down to my government benefits. And this is where I've indicated that they're taking them at age 70. So going back to the planning pages on the combined view. And I scroll down to the bottom. I don't see any shortfall. There's still assets left over at the end of the projection here. So before I go into the next step, Yulia, I'm not sure if any questions have come in.
Hi, Dan. We do have one small question, which actually is related to scenario setup,
Okay.
and I think it's good if you can show others how to do that. It's how can we check and change the contribution room for RSP and TFSA when we're creating a scenario? So within the scenario setup, if you can.
Yeah, no,
Um,
that's
you
a great.
showed the hovering, but there you kind of can't control it if the number you're seeing is incorrect.
Yeah, no, that's it's a great question, Yulia. So I'm going to go over into scenario setup. I'm going to go down to the assets section. And then under financial assets, you can see the different subheaders here for TFSA and RSP. So if we click on TFSA, there is the TFSA contribution room for 2025. So by default, SNAP will assume just the annual maximum. However, if your client never contributed to a TFSA before, this is where you could update the contribution room. So I believe for 2025, the room is 102,000. So again, if your client never has contributed, you could enter that amount here. And just like the TFSA tab, the RSP tab still has that feature as well. So RSP contribution room for 2025. So any unused room can be updated in this field here. And that will be accounted for on the planning pages if you were to hover over the contribution and withdrawal column. Does that answer the question, Yulia?
Yes, that's perfect. Thank you.
Yeah, my pleasure. Okay, so now that we've kind of created our 3 scenarios, let's compare them to see which one would be the best option for these clients. So I'm going to go up here on the 3 lines, and there's the compare scenario feature. And each column indicates each scenario, starting with the different metrics based on the scenario, the goal progress. So based on that level of spending of 70,000, we're at 103% on our base scenario, taking CPP at age 65. Again, we ran into that shortfall, taking it at age 60. So we're only reaching 93% of our goal. And then taking CPP at age 70, we're actually exceeding our base scenario at 109%. So right off the bat for these clients, I'm going to say I'm going to eliminate taking CPP at age 60. So I'm going to remove this compare scenario. So you can do that by changing what we're viewing here by selecting different scenarios. And I'm going to unselect the age 60 scenario. And let's go back in and just take a look at those two. So now you can see we just have the two scenarios, and now we do have a third column letting us know the difference between the two scenarios. So again, the goal progress, 103 versus 109. So there is a 6% difference in favor of CPP at age 70. And we can take a look at the other changes here. So lifetime personal tax. So we are paying more in regards to taking CPP at a later age, delaying the benefit. You can see the lifetime benefits for taking it at age 70 is an increased benefit amount of 428,000 through the life of the plan. The financial assets actually for the personal estate, so the end of the year of the projection, we're ending up $433,000 more in financial assets. And then if we go to the estate before tax, factoring in tax on estate, and the final estate after tax, again, in favor of taking CPP at age 70, we're ahead about 438,000. So a very quick way to see which would be the optimal choice. So I'm going to move forward with taking CPP at age 70. So now that I'm on that scenario, I want to touch on the order of withdrawals for this particular scenario. So I'm going to go back to the combined view. So SNAP's order of withdrawals when funds need to come out of the accounts to help cover the expense goals is non-registered tax-free savings and then RSPs. And you can see that indicated here. So here's the value of the account. Here are the withdrawals. So you can see once that account is depleted, we then start drawing down the TFSA. Once the TFSA has been depleted, you can see here the RIF withdrawals are bumped up, and that kind of carries us through the life of the plan. However, I'm curious to know if we were to change the order of those withdrawals, will that make an impact to the plan? So I'm going to hop over into a new scenario, and I've labeled it with my preferred new order. So I'm going to hop into there. And I'm going to show you how you can change the order of those withdrawals. So if we go up to financial assets and select the financial assets gear icon, it's the show CFM order. You want that to be checked, and let's hit save. And then if we go over to the individual view, there is this new CFM order column, and you can see contributions and withdrawals. We're focusing on withdrawals right now, and I've already gone in and updated this to reflect I wanted to actually take from RSPs first, then non-registered, and then finally tax-free. So you can change that order by just clicking and selecting a new order. So again, here's our default that I've changed from non-reg tax-free RSPs to RSPs non-reg tax-free. I've copied it down for the life of the plan, and then I ran that scenario. So now this new order has been applied to the scenario, and we're just going to go back to combine and take a look at what that looks like. So you can see here now RIF income is first being drawn from, and then once that account is depleted, we then move over to withdrawing from the non-registered portfolio. Once that account has been depleted, we then start drawing from the tax-free savings to get us to the end of the projection. So this small change, I'm just curious to know what impact that makes compared to our standard default order. So I'm going to go back in and I'm going to compare that scenario yet again. So I'm going to select my age 70 and now age 70 with the new order of withdrawals. Okay, so we can see each of the different scenarios, and again, with the difference column. So there's actually an increase in our goal progress based on spending 70,000 by 3% by changing the order. A big one here is we're actually going to be paying less in taxes over the life of the plan by changing that order of withdrawals. we actually end up more with more financial assets, specifically the TFSAs, by 209,000. And then again, going to the estate before tax between the two, factoring in tax on estate and the estate after tax, we're actually ahead 247,000 by just changing that order of withdrawals. So just that little change has made a significant impact on our plan. And again, drilling down further, I'm now going to move forward with that new change in the order of withdrawals. So again, going to the very bottom here, we can see what's left over at the end of the projections, 838,000 roughly. So Ryan and Aaron are curious to know, well, maybe we could spend more than our 70,000. So what would that look like? So I'm going to go into an increased spending scenario that I've already made up. And they've decided that they want to change this 70 to 80,000. And that can be done right on the planning pages. So I'm going to click on the first year of retirement. I'm going to change this to 80,000. I'm going to copy it down for the life of the plan to age 100 for Ryan. I'll hit the check mark. I'm going to run that scenario. And let's see what that looks like. Okay, so we can see the 80, we're scrolling down, but then we can see they actually start running into a shortfall based on that level of spending at age 87 and 85 in 2053. So again, not ideal. So what I would recommend in this case is perhaps we run a sustainable spending recommendation. So that can be found up here. And it would be the bottom left option here. So before applying any recommendation, we typically recommend that you copy the scenario before applying the recommendation. And you can do that right on this page just by hitting that check mark. I'm now going to calculate what is a sustainable spend for the life of the plan to draw down all the financial assets to basically zero to see how much they could reasonably be spending. Might take a few minutes. And there's our answer. So 73,368, which is approximately 6,632 less than the 80,000 that we've entered. So if we apply and run that, it's going to create a new copy of this scenario, and you're going to know that by the title once this is finished running. So you can see up here, it has my original title for the scenario, but in brackets, sustainable spending. We now have that new sustainable spend number applied to the recommendation, or based on that recommendation. If we go to the very bottom of the projection, you can see here the non-reg is completely depleted. TFSAs are completely depleted. There's a small amount left over in the RIF account, a very small amount. And then really what's all that's left over is their home, their principal residence. So going back up, so they're happy with that 73,368, but they've also mentioned maybe for the first several years of the plan, they want to spend more money. So let's go back and assume that they do want to spend that 80,000. So I'm going to update this to the 80,000 again. Instead of copying it down for the life of the plan, I'm going to do it down to when Ryan turns age 70. You can now see the changes have been applied. I'm going to run that scenario. So now you can see the 80,000 has been applied. We have that sustainable number from the previous recommendation. So if we go down, I'm assuming we're gonna, yes, run into a shortfall again, just based on that increased spending during the first several years. So I'm going to go back into my recommendations. And you can see here the ages are highlighted in blue, meaning that those ages can be changed. So we have that 80,000 running until age 70 for Ryan. So let's calculate a new sustainable number starting when he turns 71. So if I go here, it's automatically going to update Aaron's age to 69. I'm then going to calculate that. And there we go. We have a new number. So 69,460. So if I plan run that, so you can see we now have the 80,000 for the first 10, 11 years of the plan. And then we have this new sustainable number. If we scroll down to the bottom here, we can see there's no shortfall. Again, there's a very small amount left over in the RIF account. And then again, what's left over is the principal residence. So yeah, you can run a sustainable spending from retirement, but you can also run it from a different age, which is a great feature as well, especially for a situation like this when perhaps your clients intend to spend more in the first few years of retirement. So that's what I wanted to cover today. I think we're a little over time. Yulia, I don't know if there's any more questions that have come in, but again, just in summary, so we reviewed our base scenario, taking CPP at age 65. We added the additional scenarios, taking it at different ages. We've compared those. We were able to choose an optimal projection or a copy of the plan. By changing the order of withdrawals, we then, again, drilled down into a finer tune plan, and then we ran some sustainable spending recommendations. So again, that's what I wanted to cover today. And again, if there are any other questions, please feel free to let me know or Yulia know. We're more than happy to answer them at this time.
Yes, and there is actually one really good question if you can take 30 seconds to respond to it, but it's related to the order of withdrawal.
Mm-hmm.
And the question was, why did you only change it on Ryan's side and not on the on the spouse side? And can it be done? Did you have to change it on the other end as well or not?
Yeah, no, that's a good question. Sorry, I didn't mention that. So no, so once you change the order of withdrawals, I'll go back to that specific scenario. Da, da, da. So once I changed it on Ryan's side, it's also
Mm.
going to be applied. So here it is here. It's also automatically now going to be applied on Aaron's side as well.
Okay, perfect. Thank you for that. Mm.
My pleasure. Was there any other questions?
No,
Nope.
everything is good so far. Mm.
Okay, so I'll let everyone get back to their day. Again, I can't highlight enough. Our help center is a great resource for all things SNAP. You can find a lot of the answers that you're looking for. But again, if you can't find it, that's exactly why our team's here. We're more than happy to help you out. We're available Monday to Friday, again, 9 to 6 Eastern Standard Time, or send us an email by hitting that contact button. And again, more than happy to jump in, help out, review a plan with you, help you model something specific. Um, the opportunities are endless with our team, so please take advantage of it. And with that, I'll let everyone get back to their day. Thanks for joining, and I hope to see you at the next session.
Thank you, Dan. Thank you, everybody.
Thank you. Take care.